Hey, everyone, and welcome back to the 10 Key Podcast. I think we're going to settle on the 10 Key Podcast as the name of our show. Cool. Yeah. We're just discussing that now as we're recording. Yep. Welcome back. This is episode number 2, and I'm Dan Ancheta. Matt Larrabure and Ramsay Brown are here. And this show is really focused on talking about like financial issues, things going on in the economy, headlines that we want to discuss, and we all kind of come from different disciplines, all related to finance, personal finance, and banking and investing and all sorts of things like that. And 3 friends that have been kind of talking this way for a long time and decided to make a podcast about it, and here we are.
Yeah, take the ideas and the concepts what we hear about and kind of frame it in a way that is digestible for people.
Yeah. So this episode will be live on all the podcast platforms. We have to finish our registration to like put it out there officially. We have our logo and stuff. And I'll also post this on my podcast, which is By the Bay, which is all about San Francisco Bay Area real estate. Which you both have been guests on, which is exciting. And we'll like co-post that on there too. So this audience will also, people listening to this will also be the thousands and thousands of By the Bay fans out there.
Celebrity Dan Ancheta.
Yeah, exactly. Yeah. So welcome to the show. And so we're kind of getting our feet under us on this. And so, you know, kind of the structure we're going with is kind of talking about current events, things that are happening in the news. There's some big headlines, kind of dissecting things that are happening in the finance industry, and then maybe talking about some personal advice and things like takeaways for the audience. Like, hey, there's something just that I learned today, was reminded of this week, and just kind of coming out with that.
How those headlines impact the individual.
Yeah, like I have a specific thing, like advice to talk about later, which I'm going to spring on you all.
Great.
But so, Matt, what are you seeing in the headlines, and kind of give us what you're seeing going on?
Yeah, I think the top headline that we're talking about right now is the rating of the United States debt. Fitch rating lowering or downgrading from a AAA to a AA plus. It's like the one notch that it can go down. And what the heck does that mean?
I don't know. I mean, so you're like the investment dude. You got all sorts of initials behind your name. Yeah. That means that you can tell people how to invest their money.
Yeah, dude is not technical term, but yes,
right.
I'll go with that.
Okay. So you're the closest to this, like, meaning, you know, impacts you probably more than it impacts me in a way?
Maybe. Okay. I don't know. Maybe it all trickles, right? So that's one of the big items with a lot of these events, right, is how it goes from the top and then filters down to the rest of normal people, like us.
Which is really funny. So I'm looking it up on CNN Business right now. Updates. Stocks sink as U.S. credit downgrade roils market. That's headline 1. Headline 2, mortgage rates rise on debt downgrade. So maybe I'm speaking out of turn when I say it doesn't impact me that much, but so you probably look at these types of things more regularly than I do. I don't look at like bond ratings that regularly, right? So what does that actually mean if you're downgraded from AAA to AA plus?
Yeah, well, I want to jump in and say something real funny. Not funny, but what you said was always interesting to me of how they word and frame headlines.
Okay.
You said as and on.
As, on, yes.
Right?
Yes, I did say that.
What was the...
That's correct. Verbatim. As and on were in there, yeah.
Yeah, so it's not because.
Right.
It's
correlation and causation. We're dealing with some nuance there, right?
It's a way of saying these items happened, but we can't really confirm this one. The stock market went down because of the ratings change. It just happened to be that same day or the day before.
Coincidentally.
Right. And that happens all the time when we're talking about headlines and news items. They say, hey, this happened and this happened as the same time. Doesn't mean that they actually caused each other.
Yeah. Well, because it's not in isolation, right? Because there's other things happening all over the globe with corporate, news and CEOs changing and other countries dealing with their financial situations, right? All these other things.
Yeah,
so
the finance world is so interconnected at this point.
That's exactly the point.
It's really hard to separate that out.
Right. So what does it mean?
Yeah. So the Treasury is the United States government's tool to borrow, right, and the ability to repay the debt. There's 3 ratings agencies that are the top ones. There's S&P, Standard & Poor's, Moody's, and Fitch. And Fitch came out and said, you know what? Our top rating is AAA, and we're lowering that rating by one notch to AA+, which is still a very, 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 very good rating, but it's not the highest rating possible.
Okay. So nothing above AAA. There's no AAA plus.
For Fitch.
For Fitch.
Yeah, every rating agency has their own
of
different
course. Because if they were the same, it'd be too easy to compare.
Yeah, why would they do that? That would make no sense. So they're saying there's a lot, essentially they're saying there's a lot going on. There's the debt ceiling conversations and this political dysfunction and this argument back and forth all the time. And they're saying, hey, you know what, we see concern out there, so we're going to lower the rating. There might be a chance that there's a higher possibility of not repaying. Doesn't mean there's a high possibility.
I mean, is that even? To me, it's kind of like a nothing. It means kind of nothing, right? Like the U.S. debt is backed by the full faith of the U.S. government and all of the different instruments, and it's the default currency in the world. Like they could call it whatever they want to call it. They can rate it whether they want to rate it, but it doesn't actually. To me, maybe it doesn't actually mean anything. Does it mean something? Am I missing it?
Well, I mean, Fitch, and it's kind of making that decision to downgrade it. It's saying, the full faith in backing the United States government isn't maybe as strong as what has been. But then
what's better then, right? Because is there something that's still what's AAA rated?
There are two companies. I'm blanking on who it was, but there are two companies that are actually rated higher than the United States government now, which was kind of interesting. But like you said, what does that mean?
Right.
Like, how does that impact anybody? Does it actually matter? I don't think so. Long term,
okay.
Short term, long term. I don't think it makes a big of a.
I mean, it's making the markets move, or it's contributing in part to potentially making the markets move, right? But does it actually mean anything in the long run, or this is just this like sensational news story, and it's now everyone has to look up and see what Fitch is, and they're getting hits on their website.
Yeah,
it means we have something to talk about in our podcast.
Fair. What do you think? Does it mean anything?
I don't. The rating agencies themselves, which we can talk about if you want. I mean, and some of their contributions to what happened in the Great Recession.
Mm-hmm.
They're just bodies of and corporations themselves.
Right.
And so I don't think any investment person like Matt is going to necessarily change their decision around buying or selling U.S. Treasuries because Fitch moved it one notch.
Okay.
So I don't, maybe on some really extreme levels somebody's taken note of that, but your average asset manager, I mean, you can speak to that. I don't think that's going to really change what they think.
Oh, I agree. And there's in our industry when it comes to investing in bonds, there's what's called the spread, the difference between rates for this type of bond and that type of bond. And the treasuries have the highest likelihood, the highest guarantee that it's going to get paid. So it's going to have the lowest, essentially the lower yield than something like a corporate bond that has a higher propensity to default.
Higher speculation.
So the spread is there's the difference between those two yields or rates, right? So that spread now might get smaller.
Okay.
But the reality is it's probably not going to make a big difference because that spread might be minuscule difference.
So two quick updates. So looking really quickly. So there are still some countries that are rated AAA by Fitch. Germany, Denmark, Netherlands, Sweden, Norway, Switzerland, Luxembourg, Singapore, and Australia.
Interesting.
Canada is rated AAA by two of the rating companies, but not by Fitch. So there are countries that are not the default currency and don't have the size economies that we have, right?
I think that's a big part of it, is the size of the economy,
right,
as it's relative to the rating as well.
Yeah. And just so everyone knows, the Treasury calls this arbitrary. So they agree with me that this is nothing and to move on. And but this isn't the first time that there was downgraded, right? Did we have another downgrade last time there was a debt ceiling crisis?
So the last time it was downgraded was the S&P downgrade in 2011.
Okay. What happened then?
Why did they downgrade, or
no,
what happened since?
What was going on?
Why did that happen? And number two, I mean, off the top of your head, of course, you know all these things. And like, was there a lasting impact to that, or was it just kind of like, meh, okay?
I think lasting impact is pretty clear that there really wasn't a big deal because we're here now.
Right.
And really that was you could argue that lowered rating was because of tension in the debt ceiling back then. And we're kind of seeing that again.
And it getting more, maybe that's the topic, like it's getting more pronounced, right? This fight between the different political factions, and they can't agree on anything, and the stuff that should be really simple, they just turn it into a big old mess, and then there gives uncertainty to the markets.
Try and leverage it to get something.
Right.
Rather than just making sure that, everybody has faith in the U.S. government and the treasuries, and, they're positioning politically to get something from that thing that needs to happen.
Yeah, and it doesn't, again, doesn't do just like a political football. They're going to fight back and forth, and then they're going to get payback on this thing, and they won on this one. And it makes for a lot of turmoil and a lot of kind of uncertainty, I guess. And in that way, the markets move. But at the end of the day, I don't think it actually changes much for anybody, except for the traders who are making some profit off of it today.
Yeah, I mean, small movements can mean big dollars in the bond market. The amount of money that gets traded in the bond market is so much larger than the stock market.
Yeah, I heard that once. You know what those?
I don't know the numbers off the top of my head. I maybe for next month we'll talk. Next podcast we'll talk more about that. But
when people think of investing, they think of the stock market
for sure.
But there's of all the dollars invested, it's staggering how much is not in the stock market. Correct. It's in the bond market.
Correct.
So maybe educate us a little bit on what other types of bonds are people trading?
Yeah.
Right? Like you think of bonds, I think of U.S. Treasury bonds, but there's countless other types of bonds. So maybe dive into that a little bit.
Sure. We'll first just define what a bond is. It's just debt, right? I'm borrowing money.
Who's debt?
Right? A variety of people, but from a baseline, it's borrowing. Bonds are borrowing, are debt instruments, right?
Okay.
And you have our government, United States government. We have state governments. Okay. We have counties. We have cities, municipalities,
right? Muni bonds, right?
Exactly. That's a different term, different category of bonds. And
each one of those
bonds. Each one of those has their own rating, right? Each entity, each organization. And then on top of that, you have corporations, businesses. And then on top of that, you have the length of time or the maturity from short term, 30, 40 years, right? So even you have all these different entities. You also have a huge range of maturities. And that's why it's so much more dollar-wise in the bond market than the stock market.
Really interesting. So I think in that regard, I understand the need for, a company like Fitch or Moody's or whatever to rate those types of things. Mm-hmm. Like if you have two alternative muni bonds between, the city of Oxnard and the city of Reading, whatever, which one is relatively more risk? Well, they're going to dive into the finances of the cities and look at their cash flow streams and their tax base and stability of all these things, and then give it a rating. I think that's meaningful. But to say, well, the U.S. government is no longer the best rating is kind of silly, in my opinion. So,
I think it makes sense for them to move to inch versus jump, right? You don't go from a AAA to a BBB overnight, hopefully. If you do, then there's some major problems there, right? So if they're inching down, it eases any kind of burden. Right. They're saying, hey, there's some concerns here. There might be other countries that have a better rating, that have a higher likelihood of guaranteeing the payment's going to get made. There's less turmoil. Right. But the dollar amount's not there. They're not being the reserve currency for the world and all of these different aspects. So to your point, I don't really think it isn't going to move much, isn't going to make a big deal, isn't really a big deal in the long term. But it's a sign, it's a signal. Heck, it might be just covering their butts.
Yeah. It's probably one of those notes that we look back 10 years from now and go, remember that time when they downgraded the debt? Right? Because it's a moment in time and it'll probably heal.
We didn't remember 12 years ago.
Yeah, we don't remember. Yeah. I mean, off the top of my head.
But it's a footnote in an article, right? Because it's like, oh, yeah, this happened before. So go back to the bond thing. I think that's an interesting topic. Like, how do those get made? What are common things that people should know about bonds and
from an investment standpoint, from borrowing?
Why they exist and why would a company create a bond or a city create a bond fund, right?
Well, I'd like to take a step back and hear Ramsay a little bit more, because he deals more directly in the borrowing side of with businesses. And so just from your perspective with the ratings and how interest rates play and move, do you see this change affecting interest rates on the corporate debt side and borrowing and inability to borrow?
Not really, frankly. I mean, like I said, I doubt it's going to move the treasuries a material amount in terms of, if you were buying a treasury at AAA yesterday, are you still going to buy a AAA or an AA plus treasury today? Yeah. So I don't think the demand's going to dry up and cause treasuries to change what they're trading at. And in the lending world, we base a lot of our decisions on basically U.S. debt, the risk-free rate of return, and okay, how much over that should we be pricing our debt?
Mm-hmm.
How much should we charge over risk-free? I mean, that's the heart of the lending decision is, okay, are they worth lending money to, and then how much risk is embedded in that? So how much should we be charging?
What does risk free mean? What does that mean?
Well, I mean, in this case, it's the treasuries. I mean, the highest rated. I mean, there's basically almost no chance you don't get repaid. So there's no risk of you not getting your money back.
So as an alternative investment, right? You have a choice of what you're going to invest in.
Yeah.
If you can just put it into a treasury and you're going to get your 4.09% or whatever that is, right, on a 10-year treasury, right?
Mm-hmm.
And if you're going to decide to do something else with the money, it has to be, the additional risk has to be worth the reward, right? Is that, So how would you explain that?
Yeah, that's so like banks. I mean, what banks do, and we take people's deposits and then we use those deposits. Those are liabilities for the bank. We, if you come to us and ask for, hey, we've got $8,000 in my checking account, give it back to me. We have to give it back to you. So that's a liability for banks, and then we take those deposits and we lend them out, and now we can also buy things like debt instruments, and that was one of the reasons the banking kind of turmoil happened most recently was with treasury rates rising as rapidly as they did. Banks that held a lot of investment dollars in treasuries and muni bonds and other things, the value of those bonds, the book value or the market value went down, and so you can talk to that inverse relationship between rate and value. But when it comes to the banks, if I'm putting dollars out the door today, and I can get 4% by just giving to the U.S. government, if I'm going to give it to Joe Schmo's car wash, I better be doing better than that, because Joe Schmo is not the U.S. government.
Right. There's more risk in the car wash.
So
right.
Yeah, and so then that's what.
So that's how you kind of determine
really
what you need to charge Joe Schmo to borrow the money.
Yeah.
We need to come up with like the name of like the hypothetical, because we're gonna have like all these examples. We need to come up with like the standard.
Joe Schmo car wash.
Sure.
I like using him as an example for all businesses.
In college, I had this professor who put everything in like terms of beer.
Oh yeah.
And it was like, if you have a certain number of dollars and you can buy X amount of beer, like, what is the like alternate investment that you need to make to get like more value than the beer? And like, well, I'm gonna make sense of that. So anyway, not that one. So so I think what you're saying is, for the bank to like lend the money to Joe, the rate has to be at more than 4%.
Yeah, I mean we have to obviously, goal number one is, okay, let's look at their financials and make sure that we think they can pay us back.
Assuming that they have solid financials and a repayment stream and all the other stuff, that the criteria to make a loan to them. Yeah. When you're just looking at pricing, like, what do we charge Joe?
Yeah.
Joe's creditworthy. What do we charge him?
Yeah. Well, and then it gets into that gray area of, how creditworthy.
Right.
I mean, that's where, again, going back to the ratings issue. I mean, we're essentially, as a bank, we're rating that borrower. And so depending on where they are in our tolerance for risk taking, if they're kind of on the edge down here at the bottom, we better be getting an appropriate return. If they're up here way high and, they could go to anybody in town and they would say yes immediately because they just know how strong they are, then, okay, well, now we're kind of more competing on price.
So you can't just look up my business credit score? It's
No.
not out there like the FICO score? I don't have my business Joe Schmo FICO score?
Not really. No. I mean, public companies get rated.
Right.
But private companies, I mean, their information is not, unless they choose to share it with you, it's not out there. And so that's a misconception of, is Joe Schmo's business, creditworthy, and what's their credit score? And it's like, that doesn't, for a business, that doesn't really exist. Right. Especially not for closely held. I mean, it does for public stuff, and because you have these rating agencies that do that digestion for you. But in the private, if it's not publicly traded, it's a black box. So there is no, unless they actually share it with you and you have the knowledge to make that decision about how creditworthy they are, it's unknown. So, and just walking into a business, you're not going to really know what their financials look like or what their financial condition is.
So it's really interesting, kind of like maybe the trickle down we were talking about earlier is like, okay, so this decision is made, Treasury, the 10-year Treasury is up 5 basis points today. And so, that does, I guess, have an impact on, the community bank, on the mortgage lender, on all these things, because if someone's going to buy a mortgage-backed security as opposed to U.S. Treasury, the yield on that mortgage-backed security has to exceed what they can buy on a U.S. Treasury, right? If the bank is going to make a decision to take the dollars that they have on deposit from their customers and lend it out to the car wash, that has to exceed the yield that they can get from buying a U.S. Treasury. And also the liquidity factor of, like, you can't just call Joe and say, hey, I need my money back tomorrow.
Yeah, no,
where
we have a contract with them.
Or you have a contract, and that kind of ties up those dollars. Whereas if you buy a U.S. Treasury or mortgage-backed security, it's relatively liquid. Of course, we found out from some large banks who no longer exist that how liquid they are and how much of a haircut you have to take in the value of the investment that you made may be a determining factor of whether you sell or not and how much money you get back from the investment.
Yeah.
But in theory, it's relatively liquid and safe.
Yeah.
Right?
Mm-hmm.
Okay.
You mentioned something here that you might want to define for our two audience members.
Go ahead.
Basis points. A lot of people don't know what that means. And
I don't even know what that is.
Yeah, you do. You can define it. You talk about them all. You talk in basis points all the time.
I do. So 1% is 100 basis points. So when we're talking about like fractional changes in rates and yields and that sort of thing, instead of saying it's 0.05%, we call that 5 basis points.
Yeah.
Yeah. So it actually took me a long time to figure that out for some reason.
Because
people start, like, when I joined the mortgage industry, there's so much jargon. I'm sure in your industries too. It's like 100%. So much jargon. And I'm like, dude, I have no idea what you're talking about. Let me write this down and like I'll look it up later, because I was too embarrassed to go, can you tell me what this means?
Yeah. But same story, same item, bips.
Yeah.
Same thing.
It's basis points, but we're throwing out bips everywhere. I'm like, brand new in the industry. I'm like, what's a bip?
Yeah. So for real, I still don't understand what a tick is.
Ooh.
I mean, not a TIC, that's a tenant in common, but it's like the
little bug.
Not that either.
Bite you.
Yeah. So like when we're looking at pricing for, depending who you're talking, the different analysts look at different things. So some people like say the X amount of change in basis points, and other people call it like ticks. It's a 16th of a point.
Huh.
I don't understand.
My understanding for ticks is more just movement. It ticked up, it ticked down, and it's got this many ticks. I don't think it's a defined like quantity. It's more of
I'm gonna look it up.
I think ticks are more movement.
See, we're learning something. We're educating and learning at the same time.
I like this. I like this idea. There's so many little terms that we can define.
Yeah, because I don't deal in like the trading stuff really at all. So that's like a term I've never really even heard.
A tick.
Yeah.
Yeah.
Because that's a market thing that I don't deal with day to
there's
day.
a lot of things like, okay, you want to do it on an uptick or a downtick or something along those lines on the trading side. Not that I'm a big trader. We don't do much day trading. Very little day trading or like active trading in portfolios nowadays. It's not something we typically do. But there, more and more actually, we've been clients holding CDs, treasury bonds, agency notes, different bonds from different organizations because the yield, the return is there for short term, 6 months. I'm not trying to quote rates right now, but there's attractiveness there.
That hasn't been here for 10 years or so. Yeah.
Right.
Yeah.
Which is
because that's affecting banking too. I mean,
For sure.
People are much more sensitive to the rate they're getting on savings accounts and things like that because it's available now, and it hasn't been for a long time. So banks are having to pay much more attention to what they're giving their customers in terms of rate to hold on to those deposits because they're valuable.
Yeah, we talked about the inverse relationship a little bit. Maybe define how that works with bonds and interest rates.
Yeah, no, I think this is one of those you need like a chart for.
No,
but
you can. It's pretty easily. So bonds are typically priced in quantities of $1,000. Right?
Okay.
I want to buy a bond. I don't buy $10 of a bond. I have to buy $1,000 of a bond. Right. Whereas stocks, you can buy a share for $5 or fractional shares through some of discount broker online. Right.
Yeah, sure.
Can't really do that with bonds the same way. So if you buy a bond, $1,000, here's $1,000, you're going to get this bond. It's going to mature, say, in a year. And at the end of the year, you get 5%, just for example, easy numbers, right? Well, if interest rates go up, the market interest rates go up to, say, 6%, right? You're going to get your 5% at the end of it, and you get your $1,000 back. But what if you want to sell it early, right? Dan, you want to buy my bond, or I want to sell it. I'm going to sell it to Dan. He's like,
that $1,000 all of a sudden.
I need money all of a sudden.
Right.
I'm going to sell it to you, but why would you pay me $1,000
for 5%
when you can get 6% for $1,000?
Right.
So I have to give it to you for less than $1,000, so it equals a yield. Your return would be similar.
Okay.
To what the market.
So
is.
You can't sell it to me for $1,000. You have to sell it to me for $997, whatever
it is.
Yeah. So that when you back into that math, I'm getting a 6% or close to
something along those lines.
To that. And that's how you get liquidity back out of the market.
Correct. In the bond market when you're selling it early.
Okay, so if I buy that, let's just say I buy it for $950, right? Mm-hmm. If I hold it till the maturity, I get my $1,000 back.
You're going to get that 5% off of $1,000 and $1,000.
Yeah, that's a pretty good deal for me.
Which equates to if you gave $1,000 and got 6%, so that you end up in the same place. Yeah. So the dollar for dollar at the end is exactly the same. And
but I don't have to come out of pocket for $1,000. I might not have $1,000.
Theoretically,
right? Yeah. Very interesting.
Yeah.
I remember learning about that, and obviously that's like comes up in my world a bit, but the way that you're explaining it makes a lot of sense. Like, I can get a higher yield. Why would I buy your bond when I can go buy a brand new bond that the U.S. government's trying to sell today at today's yield? Yeah. And then based off what they sell the current vintage for, the value of the stuff that was originated 2 years ago, 3 years. So if you bought a 10-year U.S. Treasury 3 years ago in the middle of the pandemic when the U.S. Treasury was trading for 30 cents.
Yeah, so cheap. You're
in a bad place right now.
Mm-hmm.
Yep.
Unless you hold it to maturity, then you get all your money back.
You get your money back. But if you want to sell it early, you're going to have to take a haircut.
Yep.
Because I wouldn't buy that bond for face value for $1,000. Why would I?
Yeah.
I can get
one direct from the Treasury and get my.
Except for that, it's 3 years old or 4 years old, right?
Correct.
And so you only have to wait 6 years to get your money back.
Yeah.
So then you're pricing against a
shorter
a 5-year bond versus a 10-year bond,
right?
Or whatever.
That would get priced in the duration,
right? What's left till maturity, you get your money back.
Yeah. So
wasn't the government
comparing against 7-year Treasury?
Was it an idea that someone had, or did they actually do it where the U.S. government was basically like, come cash in those bonds and we'll honor them at face early? Was that the thing that was happening?
When the banks were having liquidity issues, that was something that the Fed did set up to try and provide the liquidity to banks that were having issues.
Right. We talked about this last time, right? So, like, run on a bank, people need their cash. You said it's a liability. Yeah. People come in and say, "Hey, I got $5 million on deposit. Give it back to me."
Yep.
And if the bank doesn't have all that money, it's all tied up in these securities. They got to look at those maturities and go, "I got to sell a bunch of this stuff." So I turn it into cash and I can send it to my client.
Yep.
Right?
Yeah.
And depending on what they have, they might be selling at a severe discount.
Yeah.
Like,
and that's why the recent kind of bank issues and failures, I mean, they were all just liquidity related.
Right.
And there's no credit issues really.
And a timing issue, right? Because all that money is still there. They're still going to get their full $100 billion back in the treasuries that they owe. It's just they can't get the full $100 billion right now.
Yeah,
and
because
might
the
need
value
it.
have gone down.
Right.
Yeah. And if when it came to the bank runs and all your depositors are asking for the money back at the same time,
right?
You either have to take that haircut or a couple of cases go bankrupt,
right?
Because somebody else has to take it over and provide the liquidity to make those depositors whole, and that's where the FDIC kind of steps in. Things happen there, but so that's what the FDIC kind of did in those situations. Okay, well, we just give your deposit, the liabilities to another bank. They step into those shoes, and then they have to figure out the rest of it.
Right, but they're a top 4, top 5 bank in the country, and they're not going anywhere. And they've got plenty of cash and reserves, and they probably hold a lot of the same bonds that the bank that's going under owns, but they just have enough cash to weather the storm.
Have the liquidity, the access
and that's,
to liquidity.
That kind of goes back to your thing about the Treasury facility. Yeah, it allowed banks to basically borrow against the face value of treasuries and other high quality investments that they had on their balance sheet, so they didn't have to sell them and take the haircut.
Right.
So just
they can hold them to maturity,
yeah.
get all their money back, but borrow against the value of it.
Yeah, today, so that they could meet the demands of the depositors who are asking for their money back.
Right, because that's an
because if they can stave off
right.
the liquidity issue long enough, the bank stabilizes and it doesn't fail.
Right. And
so
there's kind of a PR marketing thing where they got to make sure everyone knows that all their depositors know that everything's going to be fine. Don't worry about your money.
And the Treasury even kind of, I'm sure there was some arm bending going on, but they had all the big banks put deposits into
willingly
put deposits into
put deposits
into the banks that were having liquidity issues because they were basically giving them new liabilities that would stick around for a while so that they could hopefully ride out the liquidity issue.
Right.
Because again, the loans that they made and the investments they had, they were going to get their money back.
Right.
It's just a matter of when. And all the depositors were asking for their money at the same time, so they didn't have the time to appropriately liquidate what they had on their books as assets.
Well, and as rates continue to go up, right? So in addition to like this news, we had another Fed funds increase last week, and that just makes the cost of borrowing even more extreme, and that gap between those older bonds that might have a low yield in the sub 1% and newly generated bonds that are trading at 5 or 6 times that. That makes that pain even more if you have a liquidity issue and you're holding that older vintage of bonds and you need to get back to cash. You don't have 6 years to wait out liquidity, right? To get money be made whole.
Yeah, and to circle back to the rating agencies, some of these larger institutions, these larger banks, they're going to get rated by these institutions. They're going to look at what's on your balance sheet. What is, you have however many billions in treasuries. Well, if they are doing their job correctly, they're going to dig in and say, what type of treasuries are these? Are these 1 years? Are these 5 years, 10 years, 30 years?
How often do they mature?
Right.
When, what's the rate?
Having like that ladder kind of, you always have constant maturities happening so that you have liquidity happening. Wasn't the one big issue, maybe, Ramsay, you can explain a little bit, like they're more being marked to market. We talked about this last time. So basically,
there's in banking and in accounting, there's 2 classifications of investments. There's available for sale, which basically says, I might sell them today. I don't have to, but they're available for sale. If somebody said, I really like that treasury, I'm going to give you an extra 2 basis points, over and above. And you say, okay, sure, you can have it. And then there's the held to maturity. And so a lot of banks, they don't trade in these treasuries, especially medium and smaller sized banks. They don't, they buy the investments and the treasuries and the muni bonds and the other things to get a return when they don't have either attractive borrowers to lend the money to, because you usually get the best returns by actually lending the money directly to an individual or to a business. But they make the decision. Well, I don't have enough borrowers to really get the top return that I really want. But so I'll deploy some.
Right. But this is better than zero.
Yeah, this is absolutely, because you still got to earn a return on those deposits that you're getting. I mean, that's the only way the banks make money.
Right.
I mean, there's other levers and fees and things like that. But the core of banks is making money by taking deposits and lending it back out.
Right. Taking deposits, paying what you pay to hold those deposits, and then lending it out
at materially higher rate.
Higher rate, that gap.
That
Spread.
interest rate spread. Yeah, it goes back to that spread. So, when you're buying treasuries, that's your risk-free rate.
Right.
If you're making loans, especially if you're making good loans to credit-worthy but higher risk borrowers, you're getting a good, nice chunk spread over and above what you would get on the treasuries. And so, your cost of funds is what you're paying your depositors.
Right.
Those are the factors that go into a bank, and how much money does a bank make is what levers can we pull to keep our cost of funds low and get our rate of return on the dollars that we have either invested or lent as high as possible. And the farther you can push those two apart, the more profitable you are.
Right.
And so banking, that's banking 101.
Right.
Just trying to get that separation, but it's hard to do because banking is competitive.
Well, especially like in this recent market, like just how quickly things turned.
Yep.
Right.
Mm-hmm.
Like the acceleration of the market is really damaging to people because you have these low long-term fixed rates that are committed to.
Yep.
And, but now those same dollars can be deployed at a 3 times, multiple rate of return.
Yeah.
So that's a hard pill to swallow for a lot of,
a lot of commercial banks
yeah.
have commercial loans, especially commercial real estate loans, which tend to be on the lower risk side because they're backed by real estate. They have commercial real estate loans that are priced at, in the 3s and 4s when, they should be getting 6 and 7.
Right.
So
banks love that adjustable rate when rates are going up.
Yep.
Right. And they love that fixed rate when rates are going down.
Yep.
Right.
Yes. Yeah. You try and control that, but
right.
Well, to your point, I mean the rapid nature of the change is really what bit the hardest because, if the rates go and drift up and drift down, the banks can move at a certain speed and pull those levers and
and consumer behavior kind of like adjust to it.
Yeah.
But when it's like last week we're at 2 and now we're at 6, just that fast, not a week, but like in a couple of month period.
Yeah.
It happens so fast.
Yeah.
And there's just people, when you go that fast, things break.
Yeah, especially in the investment side, that world, it's looking out into the future, right? It's saying what is its value today based on its future probabilities of earnings and likelihood of making money. When it happens so fast, it's really hard to interpret or digest. Okay, this is what it means for the long term, so this is how it should be priced appropriately. Whether that's stocks, bonds, whatever it is, it all happens the same way. It's like, okay, how do we digest this? How is it going to be for the longer term future? When it happens so fast, it's really hard to digest that and interpret it, right? And so that's why we see a lot of price movements. I think using the start of COVID pandemic world shut down a great example. The stock market moved so fast,
right?
Because we didn't know.
Yeah.
The world didn't know. The markets didn't know how to interpret this. So when they
everybody
don't know,
just went to cash.
They it freaks out, right?
Right.
I mean, not necessarily just everybody going to cash. It's just like I don't know what the value is here.
Just
right?
de-risk everywhere you can.
Yeah, it's
you
like
just don't know.
I'm gonna say I'll give you 50 cents for this because I don't know if it's worth 50. It might be worth 75. It might be worth 100. It might be worth 20.
Yeah.
I don't really know, so I'm gonna err on the side of low.
Yeah, what's it called? So the market moved so fast. A number of days in a row, they had like stop trading because it was. What is that called? What is that mechanism?
Like break. There's like
Circuit breakers.
Circuit breakers. Thank you.
Circuit breakers.
Yeah. And so just to
so explain what that means.
Oh, geez.
I'm not asking for the exact percentage decline, but
right.
what
So
essentially
the idea is it really came in when with a lot more electronic trading, right? So
Those flash crashes.
yeah, exactly. You have a stock or an investment, right, and it's valued at $100. Right now it goes down to $90. It just dropped 10%, just like that in a flick of an eye, right? And then because it went down 10%, Ramsay might have an algorithm that says if it hits 10% or this dollar amount, sell it. Yeah. And then Dan has an algorithm that says if it hits 15% decline, sell it. And you have the snowball action of all these different stop loss systems and electronic trading items in there, and it compounds it. So then the circuit breaker comes in and says, whoa, 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 we moved way too fast, too quickly on the downside. We're going to take a break. Y'all just evaluate your systems and take a breather, and then we'll turn it back on in like 15 minutes. And then if it happens again or even more, it says, whoa, let's slow down. We're going to take a break for an hour or 2 hours, or just call it quits for the day. And then reevaluate the information and say, okay, this is really what this means.
Right. But it halts
digest it. It
the
stops.
trading.
It will stop
everything
trading.
stops.
Mm-hmm.
Yeah, that was wild. I remember watching that happen in real time.
Yeah.
And it was like,
wait, why isn't the chart moved
yeah.
lately?
Well, it was 6 a.m. or whatever time that
6:30 here.
6:30 the trading starts, and turn it on TV, and it's boom, negative 12%. And it's okay, well, we're taking a 15-minute break, and we'll be back with you. It happened a couple days in a row that.
Yeah.
And volatility moved around, but for what you're saying, we had no idea what was going to happen, and people were afraid, and they're like, "Well, I don't want to be the last one to trade this stock out." And
everybody's trying to sell, nobody wants to buy. Everybody's trying to de-risk, and nobody wants to be the one that's holding the bag if it's
And when you don't know what's going to be allowed to be open, and there's all these different potential outcomes,
you don't know.
Yeah,
that's the big thing. It's investments like known items and how to interpret them, looking out into the future. Okay, this rating, AA+, now we can digest it today. Might be why the market moved, because it still needs to digest it and say, okay, what does this mean for the long term, right? As the rating went down, the markets went down, or the markets went down as the ratings went down. Not necessarily because, but we don't really know. Let's digest it. What does this mean for the long term? And then you can value appropriately.
Got it. Cool.
Yeah, we talked a lot of stuff.
That's really interesting. I'll be curious to see what happens. I know in my world, I look at mortgage-backed securities, and this morning we were down 70 basis points, something like that, and now we're down 14. So it mostly healed throughout the course of the day, and like you said, all that rapid trading and people kind of.
Yeah. So when those mortgage-backed securities go down in is that down in price or down in rate?
Down in price.
Yield.
Down in price.
Down in price, so up in rate.
Up in rate.
Yep. Okay,
Right. So right now, the 5.5% 30-year mortgage-backed security is trading at 98.72. So basically, that $1,000 you would pay $987.20 for that.
Yeah, because they compound the problem and not clear when it's actually they quoted in at 100, but it's priced at $1,000.
Yeah. Or let's say if you buy a $100 bond, you would pay $98.72 for it. That has a face yield of 5.5%, but since you paid under $100, you're getting more than 5.5%. You're getting 6-something percent. We could do the math.
Oddly, you're actually buying $1,000 of it, but it's priced, it quoted at 100.
Well, that's what I have on my screen.
I know they quoted at a basis of based on 100.
It's easier math, base 10.
It's way easier, way less complex to do it that way. Somehow, some reason, I don't know. Somebody smarter than all of us decided to,
or somebody just made that decision at some point in the past.
Everybody says, and it's probably this site I'm looking at is probably different than another site that might quote it differently. But that's okay. So what about any personal financial advice? We kind of committed to once in a while we'll have something that comes up. We want to throw something out there and give some advice. I have one if you guys have anything.
Yeah, go for it.
Do you guys have a trust?
I don't. I've been meaning to do it for several years. I don't have a trust yet.
Get a trust.
I do not. I have some changes going on that it is in the works, but I currently do not have a trust set up.
Yeah.
I have listed beneficiaries on accounts, transfer on death for non-retirement accounts, but I do not have a trust.
Recent things happening with close friends and stuff. If you don't have a trust, get a trust, get a will, get a advanced health directive, and a power of attorney, because there's weird stuff happens in this world, and you should have a trust. So that was the thing that was on my mind. So for people who don't know, a trust is a well, why don't you explain? What is a trust?
Trust is a creation of an entity that says that actually owns money. You transfer your money into the name of this trust. So think of it as a business.
Okay.
It's not for profit, but it's a business. And in short, the goal or the purpose of it is to avoid probate. The most standard trust, and I'm not an attorney, so don't quote me on that. Talk to your licensed attorney to set this up, but it's mostly usually to avoid probate. So that what is probate when you die, the court would come in and say, okay, the money is supposed to go here, here, and here. A trust will avoid that court process.
Right.
It says the trust has, the person says, the giver of the money, okay, Dan, you gave the money to the trust. Currently, you're probably the trustee, the person in charge of the trust, the deciding person, and then the beneficiary. It's for you. The money is for you.
Right.
And when you in there, you have, when I die, the money is to go here, and the people in charge of it are these people.
Right. The successor trustees and the beneficiaries of the trust. So basically, so if you don't have a trust, everyone needs one, and really just to make your wishes clear that if you were to die, what you want to happen to your assets, who you want them to go to and what percentage, and who you want to oversee those distribution of those funds, and et cetera.
And to piggyback on that, it doesn't necessarily have to be at death. When a trust comes into play, like incapacitation.
When I'm no longer able to make these decisions for myself.
Yep. Say you get in an accident or a health issue, and you can't make decisions, your successor trustee would come in and say, this person can't make their decisions. I'm the successor trustee. I can act on their behalf and not have a problem.
Yep.
Usually it's fairly simple.
Right.
Much simpler than going through the court and saying this person can't act on their behalf and waiting months and months and months to get the court documents to do
So if you're, listening out there, please take a minute and research how revocable trusts work. Get one, set it up, because when you need it, by the time you decide you need a trust, it's too late because you've been in an accident or you've been killed or died in some way, right?
Yeah.
And
talk to an attorney about it.
Talk to an attorney about it.
You can get it online.
Yeah,
but
don't do
I
that.
highly don't.
It's way too complex.
Yep.
Don't do that. Talk to an attorney. It's worth the investment of a few $1,000s to make it happen. And it just was something that was on my mind because there's like a couple of instances of like close friends and family and things that have come up. It's like, wow, that is a huge problem now, and they don't have an instrument to like decide what's going to happen. And the worst case scenario is the family winds up fighting over the stuff. And I've seen so many examples of like close families stop being close because they're arguing over, well, actually I was supposed to get that and I didn't get enough of this, and all these things, people fighting.
Be specific. I advise a lot of clients, it's not about what you say, who gets what, it's about that you said something.
Right.
You said, okay, Dan, you own these microphones. Who do you want to have these microphones? It's not that you gave them to Ramsay. Isn't what's going to piss me off. It's going to be, you didn't say anything, so we have no idea, so we're going to fight over it.
Right.
If you say so, it's done.
These will be buried with me.
Oh, cool. Cool. That would be the likely.
Yes. No.
Occasionally, family members will still take issue with who gets
For sure.
what,
but it's a lot harder.
It's stated that this is what your wishes were.
Leave the ambiguity out of the picture, right? To give the family some certainty and say, this is what's going to happen. So that's my advice.
I like it. Agreed.
Get a trust.
Sure.
I'll check in next time to make sure that you have an appointment.
Exactly.
Well, you guys have anything else to say in closing?
No. The last thing I say is, those headlines, those newest headlines, read the article. Don't just base all your opinions off the headlines, because there's a lot more going on than just the headline as this changes, as this goes on, or on the heels of that. Take a little deeper, read the article, and ask if you have questions.
Awesome.
Yeah. Leverage your professionals in your life. If something comes up, surround yourself with people that know. Nobody's ever going to know everything, so surround yourself with people that know sections that are important to you.
For sure.
Love that.
Agreed.
Cool. Well, thanks for joining us on this second episode of the 10 Key Podcast, and appreciate you being here, and looking forward to connecting with the audience at some point. It'd be cool to get some feedback and some questions, so we'll try to solicit those when we build our audience and do that thing. So, guys, number 2 in the books. Thanks for being here.
That's great.
Boom.
All right.
Good job, guys.
Thanks.
See you in a little bit.
See ya.
Cheers.